Good afternoon, class. Uh, well, uh, in today's class, we will be discussing about financial derivatives market, which we were discussing yesterday. So today is the extension of yesterday's class, you can say. So today we will be studying about financial derivative markets in India and your last unit, that is commodity derivative market. So these two topics were remaining. So today we will finish it off as today is the last class. So starting with 1 minute. Yeah, starting with financial derivative markets in India. So first of all, I'll give a quick review about financial derivative market, which we have discussed yesterday. So financial derivatives are basically contracts whose value is derived from a underlying assets, uh, index or rate. So basically, these instruments are used for hedging risk, speculation, and arbitrage. The underlying assets in derivatives trading can include stocks, commodities, currencies, interest rates, and market indices. Now, here we need to discuss about the evolution of derivative market in India. So the derivative market in India has witnessed significant growth since its inception. The journey of derivatives in India can be categorized in various phases. So first of all, we'll come to the first phase that is known as pre-liberalization era. That was before 1991. That was pre-liberalization era. Okay. So before economic reforms, because after 1991 economic reforms came. So before economic reforms, the Indian financial system was highly regulated. Derivatives were not legally recognized, and there was a lack of structured derivative market as well. And forward trading existed in a informal manner, particularly in commodities, but there was no well-defined regulatory framework. So that was our pre-liberalization era, that is before 1991. Now came post-liberalization. So that was between 1991 to 2000. That was known as post-liberalization era. So after economic liberalization, India introduced significant financial reforms, including the launch of NSE, that is National Stock Exchange, in 1994, and the introduction of electronic trading as well. The need for risk management tools led to discussions about derivatives trading. So that was about post-liberalization era. That was 1991 to 2000. Next. Now, we'll know about introduction of exchange traded derivatives. That was after post-liberalization era, basically year 2000 and onwards. So the Security Exchange Board of India, SEBI, permitted derivatives trading in a phased manner. So let's check out those phases. The first phase was in 2000. So index futures were introduced on NSE and BSE, that is Bombay Stock Exchange. Then in 2001, index options and stock options were launched. Then in 2002, stock futures were introduced, and in 2003, interest rate futures were introduced, but they have lacked liquidity. So since then, the derivative market has expanded significantly with new instruments and greater participation from institutional and retail investors. So if a question is going to come in your examination regarding evolution of derivative market in India, you need to start with the pre-liberalization era, that is 1991, then the post era, that is 1991 to 2000, and the third was the introduction of exchange traded derivatives, that was 2000 and onwards. Okay. Now we'll discuss about major derivative instruments in India. So derivatives in India can be classified in four types. Coming to the first one, it is future contracts. So a future contract is a standardized agreement basically to buy or sell an asset at a predetermined price on a specified future date. Stock futures, so contract or individual stocks such as TCS, Infosys, Reliance. Now, then we have index futures. So contract on indices like Nifty 50, Bank Nifty, and Sensex. Then we have commodity futures. So contracts on commodities. So what commodity we know? That is gold, silver, crude oil, and you can say agriculture products as well. Another future is currency futures. So contract on currency pairs, like we have discussed in the yesterday's class, they go in pairs. Let's say US dollar and INR or euros and INR, like that. Now, the next instrument is option contracts. So options provide a right but not the obligation to buy or sell an underlying asset. We have again two types of option contracts. The first one is call option. So the right to buy an asset at a predetermined price is call option. And what is put option? Just give me a moment, please. Yeah, sorry for the interruption. Yeah, so we were on put option. So the put option is the right to sell an assets at a predetermined price. So call option is to buy an asset and put option is to sell an asset. So option trading in India is particularly active in index options like Nifty and Bank Nifty options, which see significant daily trading volumes. Next one is next instruments is known as swaps. So swaps are agreement between two parties to exchange cash flow based on predetermined formula. Now we have interest rate swaps known as IRS. So it is used by banks and financial institutions to hedge interest rate risk. Also, we have currency swaps. So it is used by companies engaged in international trade to hedge currency fluctuations. What are these two swaps? These two swaps are international rate swaps, IRS, and currency swaps. Okay. Now, the fourth instrument is forwards contracts. So, forwards are customized contracts between two parties to buy or sell an assets at a future date at a pre-agreed price. Now, unlike futures, forwards are not standardized and are traded over the counter. Okay, so these are the four types of instruments under financial derivatives. Now, we'll discuss about major derivative exchange in India. What are the major derivative exchanges? The first one is derivatives in India are primarily traded on regulated exchange, ensuring transparency and standardization. So the first exchange is NSE, that is National Stock Exchange. So NSE is the largest derivatives exchange in India and among the top globally. It is introduced index futures in 2000 and remain the most liquid market for derivatives. Also, Nifty 50 and Bank Nifty options have some of the highest trading volumes in the world. So the first exchange is NSE, National Stock Exchange. Next comes BSE, which is known as Bombay Stock Exchange. Now, BSE also offers derivatives trading, but lags behind NSE in terms of liquidity and trading volume. So, liquidity and trading volume is higher in NSE. So, also it is attempted to introduce new derivative instrument to attract traders. So, that was about BSE. Next one is MCX. MCX is multi-commodity exchange. So India's largest commodity derivative exchange it is, and it trades in metals like gold, copper, silver, and energy, that is crude oil, natural gases, and agriculture products. So what is that? That is multi-commodity exchange, MCX. Next exchange is NCDEX, that is National Commodity and Derivatives Exchange. So it is specializes in agriculture commodity derivatives such as wheat, soybean, and guar seeds. Also, it plays a crucial role in price discovery for farmers and agribusinesses as well. So, what is that? That is NCDEX, National Commodity and Derivative Exchange. Okay, I hope I'm clear with the exchanges in India. Now comes the regulatory framework of derivative market in India. Okay, so the Indian derivative markets are regulated by multiple agencies. The first agency is SEBI, that is Security and Exchange Board of India. Okay, so what does it do? It regulates equity and currency derivatives. Also, it ensures investor protections and market transparency. Next one is RBI, that is Reserve Bank of India. So RBI regulates interest rate and forex derivatives as well. It also provides guidelines for OTC, that is over the counter derivative transactions. Now the next one is Forward Market Commissions, known as FMC, which is now merged with SEBI के साथ merger हो गया उसका FMC का. So previously regulated commodity derivatives before merging with SEBI in 2015. So those were the regulatory framework. Okay. Now we'll look into the participants of derivative market. Who are the participants? So different type of market participant engage in derivative trading. The first one is hedgers. So the businesses and investor use derivatives to hedge against price fluctuation. Let's say a farmer uses commodity future to lock in a price for crops before harvesting. That is hedgers. Next is speculators. So traders who take position in derivatives to profit from price movement. Okay. Also, they provide liquidity in the market. So those are speculators. Next is arbitrators. So they exploit price differences between markets or instrument. Let's say buying in the cash, buying in the cash market and selling in the future market. So when there is a price mismatch. Okay. So those were the participants. Now, one minute. Let's look into some growth and challenges in the Indian derivative market. Talking about the growth thing, the first is the growth drivers. So, what are these growth drivers? The first thing is increased institutional participation. Uh, that is mutual funds and banks actively trade derivatives. Then we have technological advancement. So algorithmic trading and high frequency trading like FHT have increased market efficiency. Also expansion of product offering, that is introduction of new instruments like weekly options, commodity indices, and volatility derivatives. Okay. Now coming to the challenges. Give me a minute. I'll continue with challenges. Give me just a minute, please. Yeah. So we were at challenges. So the first challenge could be lack of retail participation. So, like many retailers, investors avoid derivatives due to high risk. Then the other challenge could be regulatory constraints. So SEBI imposes position limits and margin requirements, sometimes limiting market flexibility as well. So that is regulatory constraint. Then we have risk to market manipulation. So concern about excessive speculations and algorithmic trading impact market stability. So basically, all in all, the major challenges of financial derivative market, which in India we face, are lack of retail participation. So many investors they avoid investing because of what, high risk. Then we have a lot of regulatory constraints are there. So SEBI basically imposes position limits and margin requirements. So because of that regulatory constraints, the participation get lesser. Then we have market manipulation risk is also there. So like excessive speculations and algorithmic market stability. So because of all these regions, the the financial derivative market in India face challenges. Now, what could be the future outlook for derivatives in India? Uh, one- Yeah. Future outlook, talking about the future outlook. The very first one is the growth in commodity derivatives. So as India's agriculture and industrial sector expand, commodity derivatives will gain prominence. Also, introduction of new comments. One Yeah. Introduction of new products. So SEBI is exploring new uh, derivatives such as volatility indices and sector specified futures. Then we have increased retail participation. And so greater financial literacy and accessibility will attract more retail investors. And finally, the integration with global markets. So Indian exchanges are basically forming partnership with global players to improve liquidity and trading opportunities. Now, all in all, we can say that the Indian derivative market has grown rapidly since its inception in 2000, emerging as a vital component of financial system with a well-established regulatory framework and strong market infrastructure. Also, increasing institutional participation, the market is poised for future expansion. However, challenges such as you can say risk management, regulatory constraints, and market stability must be continuously addressed to ensure sustainability growth. As India move towards greater financial sophistication, derivatives will play an essential role in risk management, a liquidity enhancement, and overall economic development. Okay, so that was about the financial derivatives market in India. Now, just give me a minute. We will start our next unit, that is unit 15. Yeah. So coming to our last unit, that is on commodity derivative market in India. So first of all, we need to understand about the commodity market. So a commodity derivative is basically a financial instrument whose value is derived from an underlying commodity. So these derivatives allow traders, investors, and businesses to hedge against price fluctuations, speculate on future price movements, and engage in arbitrage opportunities. Now, uh, these commodity derivative market are basically classified into agriculture commodities, metals, and energy. So under agriculture commodities comes uh, commodities like wheat, rice, soya bean, cotton, sugar, and so etc. Under metals, gold, silver, copper, aluminium, zinc, all those. And under energy, crude oil, natural gas, coal, right? So the basically it is divided into classified into these units. Now, talking about its evolution, so India has a long history of commodity trading and informal derivatives like contracts being used for centuries in agriculture markets. However, the modern commodity derivative market evolved in various phases. Now again, we'll talk about the pre-independence era. So the commodity trading in India dates back to the 19th century when the first organized commodity exchange, the Bombay Cotton Trade Association, was established in 1875. Also, other exchanges followed, including those for wheat, oilseeds, and metals. Next one is post-independence, that is between 1947 to 2000. So the government imposed restriction on commodity trading due to concerns about speculations and food security. Also, the Forward Market Commission's FMC was established in 1953 to regulate commodity trading. And many commodity future markets were shut down or had very limited activity due to government control. Now, then came the liberalization and growth. So that was um, around 2000 and onwards. So in the year 2003, the government allowed a nationwide multi-commodity exchange to operate. The Multi-Commodity Exchange MCX and National Commodity Derivative Exchange NCTEX were launched. In, then in 2015, the FMC was merged with SEBI to create unified regulatory framework. So this is how the evolution of commodity derivative market in India has evolved. Now, talking about major commodity exchange in India, well, commodity derivatives are traded on several exchanges, each is specializing in different products. So the first one is MCX, that is Multi Commodity Exchange. So it was established in the year 2003 with a focus on metal and energy commodities. And the popular contracts were gold, silver, crude oil, natural gas, copper, zinc, and aluminum, you can say. Also talking about its market share, so the largest commodity derivative exchange in India handling over 90% of the total turnover. So that was about MCX. Next is NCDEX. So NCDEX, that is National Commodity and Derivative Exchange, was established in the year 2003. So with a focus on agriculture commodities, and the popular contracts were wheat, soybean, mustard seed, guar seed, turmeric, and zira. And the market share was leading exchange for agriculture futures in India. So that was NCDEX. Next one, ICEX. So that is Indian Commodity Exchange. So which was established in the year 2009. Also, it was relaunched in the year 2017. So the basic focus was on niche commodities and the popular contracts were diamond futures. So that was first exchange in the world to introduce this, ICEX. Okay, now coming to the next exchange, that is BSE and NSE, that is Bombay Stock Exchange and National Stock Exchange. So they were launched commodity derivative trading in 2018 to compete with MCX and NCDEX. They basically offer trading in metal, energy, and select agriculture commodities. Okay. Now, similarly, like for financial derivatives, they also have various types of commodity derivatives. Like look into the very first one is the future contract. So a future contract is an agreement to buy or sell a specified quantity of a commodity at a predetermined price on a future date, right? Then option contracts. So that is option gives the holder the right but not the obligation to buy or sell a commodity at a predetermined price. So call option is right to buy a commodity and put option is right to sell a commodity. Then we have forward contracts. So forward contract is a customized agreement between two parties to trade a commodity at a future date without exchange involvement. Then there was commodity swaps. So swaps involve exchanging cash flows based on commodity price movement, basically used by large corporations and financial institutions for risk management. Okay. Now coming to the regulatory framework. So the Indian commodity derivative market is governed by SEBI, which ensures transparency, risk management, and investor protection. Now, talking about the key regulations, the very first one is margin requirements. So, traders must deposit margins to ensure financial stability, the very first thing. Second regulation is position limits. That is, limits are placed on minimum number of contracts a trader can hold to prevent market manipulation. So, position limits is there. Then also there is daily price limits. So exchange exchanges impose daily price fluctuation limit to curb excessive volatility. Also, we have a physical delivery mechanism. So some contracts require physical delivery to enhance credibility. Now, talking about the growth drivers to the uh, derivative market. So there are several factors that have contributed to the growth of India's commodity derivative market. So the first thing over here is rising institutional participation. So SEBI has allowed mutual funds and institutional investors to trade in commodity derivatives, increasing market depth. Then integration with global markets. So Indian exchanges are linked with global commodity market, improving price discovery. Next driver is expansion of product offering. So introduction of commodity options, index-based futures, and weather derivatives is attracting more participants. Next driver is technological advancements like algorithmic and high frequency trading, that is HFT, are making commodity derivatives more efficient. Now, talking about challenges in the commodity derivative market. So, despite the growth, the market faces several challenges. The first challenge is low awareness and participation. So retail investors and farmer have limited knowledge about commodity derivatives, basically restriction market penetration. And also there is high volatility. So commodity prices are influenced by global factors such as geopolitical tensions, climate changes, and economic policies. Then there is a regulatory uncertainty. So frequent policy changes and government interventions like bans on certain contracts, they might create market uncertainty. Also, The last one is the limited physical delivery infrastructure. So many traders prefer cash settlement over physical delivery due to logistical challenges. Talking about the future outlook for commodity derivative market. So the commodity derivative market in India is expected to grow significantly due to the very first reason, that is introduction of new derivative product, that is expansion of commodity indices and sector specified futures will attract more investors. Then we have increased farmer participation. So government initiatives like ENAM, that is National Agriculture Market, will help integrate farmers into derivative ecosystems and better risk management tools. So advanced weather derivatives and commodity linked insurance products will reduce risk for businesses. Also, strengthening of regulatory framework. So, SEBI is working on better risk management practice to boost investor confidence. So, that was about the future outlook of commodity derivative market. Well, the Indian commodity derivative market has evolved into a crucial component of the financial system, offering a risk management tool for businesses and investment opportunities for traders. Well, while challenges like regulatory uncertainty and low retail participation remain, technological advancements, new products, and government support are expected to derive future growth. With increasing globalization and financialization, you can also say. So, India's commodity derivative market is poised to become a major player in global commodity price discovery and risk management as well. So, that was about the last unit, that is commodity derivative market in India. So with this, we are done with this with our syllabus of financial market. I hope I was clear throughout the classes. Now again, I would like to repeat and that if you're having any doubts regarding your subject and from examination point of view, please contact me on the email address I am posting in the chat box regarding your examination, regarding any extra notes. I hope you people are having your study material with you. So university has provided really excellent study material for you people. So kindly make use of it. Other than that, for any topic, if you feel like you need any extra notes or any extra explanation, so I'll take out time for that. So for that purpose, you need to contact me and let me know about the topics, about the issues or queries you are having, so we can discuss those things. Okay. So my email ID you can see on the screen is mentioned there. So you can contact me there anytime before your examination. Okay. Now, still time is there, and we have already discussed about uh, all the topics here. Now I'm giving you time. So if you can unmute or put question in the chat box and ask me regarding any unit, any topic which you have not understood, right? So I'm here itself, and you can unmute and ask me, or you can put a question in the chat box regarding the whole 15 units on financial markets. Okay, thank you. Yeah, I have a very interesting video to share with you all. If you could give me a minute's time, I'll play that video on your screen. So give me a minute's time, I'll play that video. That video is going to help you understand about the basics, and it will try figure it out about the financial markets and the concept of financial market in India, derivatives market and commodity markets. All those concepts will be very clear. Just give me a minute, please. I'll just play the video for you all.
They both influence and affect the whole economy. The system are intertwined and cannot be separated. Money and the financial system are intertwined and cannot be separated. They both influence and affect the whole economy, such as the inflation rate, business cycles, and interest rates. Consequently, consumers, investors, savers, and government officials would make better informed decisions if they understood how the financial markets and money supply influence the economy. A financial market brings buyers and sellers face to face to buy and sell bonds, stocks, and other financial instruments. Buyers of financial securities invest their savings, while sellers of financial securities borrow funds. A financial market could occupy a physical location like the New York Stock Exchange where buyers and sellers come face to face, or a market could be like Nasdaq, where computer networks connect buyers and sellers together. A financial institution links the savers and borrowers, with the most common being commercial banks. For example, if you deposited $100 into your savings account, subsequently, the bank could lend this $100 to a borrower. Then the borrower pays interest to the bank. In turn, the bank would pay interest to you for using your funds. Banks' profits reflect the difference between the interest rate charged to the borrower and the interest rate the bank pays to you for your savings account. So, why would someone deposit money at a bank instead of directly buying securities through the financial markets? A bank, being a financial institution, provides three benefits to the depositor. First, a bank collects information about borrowers and lends to borrowers with a low chance of defaulting on their loans. Thus, a bank's specialty is to rate its borrowers. Second, the bank reduces your investment risk. Bank lends to a variety of borrowers, such as home mortgages, business loans, and credit cards. If one business bankrupts or several customers do not pay their credit cards, then the default does not financially harm the bank. Bank would earn interest income on its other investments that offset the bad loans. Finally, a bank deposit has liquidity. If people have an emergency and need money from their bank deposits, they can easily convert the bank deposit into cash quickly. Economists use liquidity to define money. Liquidity is people can easily convert an asset into cash with little transaction costs. For example, if you take all your assets and list them in terms of liquidity, then liquidity forms a scale as shown in this figure. Cash is the most liquid asset because a person already has money and does not need to convert it to money. Subsequently, a savings account is almost as good as cash because customers can arrive at a bank or ATM and convert their deposits into cash quickly with little transaction costs. Nevertheless, cars and houses are the least liquid assets because owners require time and high transaction costs to convert these assets into cash. Economists define the money or the money supply as anything that people pay for goods and services or repay debts. In developing countries, people use cash as money. In countries with sophisticated financial markets like the United States and Europe, the definition of money becomes complicated because money includes liquid assets, such as cash, checking accounts, and savings accounts. People can convert these assets into cash with little transaction costs. Consequently, economists include highly liquid assets in the definitions of money. However, economists never include assets such as houses in the definition of money. Unfortunately, homeowners need time and have high transaction costs to convert a house into cash. Many homeowners will not sell their homes quickly by selling it for a lower value than the home's market value.
सीख लिया टेक्निकल एनालिसिस, यूज कर लिया मूविंग एवरेज, MACD, RSI, बॉलिंजर बैंड, प्राइस एक्शन, कैंडलस्टिक्स।